whether it's first-time home buyer, financial literacy, wealth management. It's something that we are pleased to do, we're honored to do, and grateful to be invited. So the three people you're going to hear from tonight are my colleagues Eric Lavoie, who is the banking center manager for our Route 132 banking center in Hyannis. You'll hear from Darren Weeks, who is a mortgage loan officer for the bank. And then finally, you'll hear from Beth Grady, who is a wealth advisor in our trust and asset management and wealth management division over at Cape Cod 5. So should be a good wealth of knowledge. We're going to try to keep it pretty straightforward and simple. Any questions that you have, put them in the chat box, save them for the end. We have set aside some time at the end to answer some questions for you as well. So if you want to go to the next slide there, Deanna. One of my favorite quotes, and I think it's quite applicable to what we're doing today. Give me 6 hours to chop down a tree, I'll spend the first 4 sharpening an axe, you know. And the important thing here is that so much of financial planning and financial literacy is about behavioral changes and paying attention to your behaviors more than it is about the math. And so really preparing and setting aside what you need to set aside for the long term is a way for you to be most successful. So from there, I'm going to let it go over to Eric, and thank you all so much for your time. We're grateful you came to us at the end of a work day, like on a rainy work day. Thank you.
Thanks, Jim. Perfect. So again, good evening, everybody. I almost say good morning. My name is Eric Lavoie. I'm the branch manager for the new facility or new banking center on 132. We're located right next door to the main headquarters. So if you haven't been there yet, I'd welcome you now to come and check us out. So the first slide here, we're looking at, well, I should say what we're going over, what I'll be going over is budgeting and credit scores and how those work. So to kind of start off, you know, I remember telling myself if I could make an extra 10% a year, or, you know, pay off some of my student loans or maybe some of my credit card debt, you know, I'd feel more financially secure. And as it turns out, usually what happens is we allow more spending to kind of creep in. So if you actually look at the chart, you'll see that 28% of people making 40 to 55,000 a year are living paycheck to paycheck. And then you'd think, you know, maybe an extra 150,000 a year would fix that. Yet 32% of those people making over 200,000 are still living paycheck to paycheck. To a certain level, there's a specific amount of income we need to meet our basic needs, whether it be housing, food, utilities, etc. But beyond that, there's something more at play. And typically what you're going to find is it's spending habits and saving habits. So if you go to the next slide, what we're going to talk about briefly is some budgeting to-do lists or some budgeting tools. So the first thing, in order to really start the budgeting process, is you want to track your spending. This is probably like the base work, right? So what you want to do is you want to track your spending for a month. You actually want to track everything, not only your spending, but also your income. The best way to do it is to use whatever works for you. It could be a website, it could be a spreadsheet, it could be a whiteboard, something tangible so you can actually see it and monitor it and, you know, kind of play with it as months go on. Then what you're going to do is start determining needs versus wants, right? So an example that I use when I you know, kind of play with my budget is, you know, what are something that I'm currently using but not necessarily gaining a lot of joy out of, or maybe not utilizing all the way and still paying for. A good example would be Netflix or Hulu, or maybe like a Prime membership, any type of those membership services, maybe the audio or the you know, the music ones too as well, any type of subscription services. Once you kind of gather that, you really want to dig into what's more joy and what's more mindless spending. Something that comes to mind for me that, you know, I had to think of a long time ago was, you know, during the work week, it's so much more convenient just to run out of lunch break and go down to Subway or go down to, you know, one of those restaurants just to get a meal for lunch. And then I realized how much that was costing me. So I had to figure out, okay, am I getting this because I'm enjoying it, or am I getting this just because I'm lazy? And so I ended up bringing lunch to work and saving a lot of money. So at the end of the day, what you want to do is assign a purpose to every single dollar that you're bringing in into where it's going. Another good example of that for potential mindless spending, or I'd say, you know, off the cusp spending, is at least what I do is put a time value to it too as well. Let's say I'm making $20 an hour and I'm out at the mall and I happen to just see a pair of jeans that I'm not shopping for and it's $60. But I like them. So what I'll actually do is, I'll tell myself, well, that's 3 hours of my time that I'm not going to get back. So is this something that I really need, or is this, just a want at the moment? So it'll kind of help you decide, how to make that choice. The next section is we're going to talk about debt and debts. Do you have a plan? So do you have a plan to pay off this debt, or are you just paying the bare minimums? Obviously you want to have a plan to pay this off. And one of the techniques, or two of the techniques, I should say, that a lot of folks use are called the snowball and the avalanche method. The snowball method is where, let's say you have a few different debts. What you'll do is you'll tackle the smallest debt first, okay? Once you throw a little money at that one, it's paid off, you allocate that payment that was for the smaller debt and you bring that over to the next smallest one, okay? So now you're paying more onto the the next one up, I should say. Once that one's been paid off, then you can, kind of move forward with that. The avalanche method is doing the same thing, looking at those same debts, but instead of going towards not necessarily the smallest one, but going for the one that has the highest interest rate. Okay, there's a school of thought that, you will save a lot of money in terms of interest that way. Either one's fine, but the most important thing is you have to pick the one that works for you and appeals to you. Me personally, the snowball effect works the best. I recently paid off one of my student loans, and I've been able to allocate those funds to, the next student loan I have, which is a higher dollar amount, which is nice because I think I calculated and I'm going to be saving 30% in interest and about 30% in time, by doing this and kind of sticking with it. So the third budget to-do list we're going to look at is savings. First thing is pay yourself first. And you hear that a lot, and how do you define it? And it doesn't mean go out and buy a brand new TV or that brand new, Jeep Wrangler that you've been wanting for a long time. What it literally means is pay yourself first. So the first recommendation would be to look at your employer match for your 401k, right? So if your employer match is up to 5%, if your contribution, make sure you're maxing out at 5% of that contribution. You're leaving free money on the table. You'd be surprised at how long and how fast that starts to grow, especially with the younger folks if they're going to start doing that. The second thing I would recommend, that actually we hear a lot at the banking center, is savings goals. Some people can't really define that. Some people know exactly what they want to save for. But if you don't have one in mind, I would definitely recommend creating a plan to have an emergency savings built up. They typically recommend 3 to 6 months in emergency savings saved up, which might seem like a lot for a lot of people. If it's too much, start small. Start with $500. Start with $1,000. In the event that you're going to get there. Everybody's journey is going to be different. Could take you a month, could take you a year. It doesn't matter as long as you're staying on that path and on that highway towards there. So at the bottom line, do what you know you're going to stick to. These savings goals, these debt management goals, these tracking spending is a lot like a diet or exercise. You're going to need to tailor it to your habits and to your needs and to your wants. And it's going to be a long journey, right? So this month might be a little bit different than next month too as well. So you have to adapt. There are, curveballs that come in, whether it's, your car breaks down or some medical bills, but as long as you stay on the road and focus on the different goals you have, you're going to be okay. Now we're going to go on to credit scores and how credit scores are calculated. You'd be surprised at how many times we are asked about this in the banking center about credit scores. So to start off, they range from 300 to 850. From a banking perspective, anything above a 720 is considered above average. Okay. Now with your credit score, the credit score is not just about the approval. Okay. Yes, if you have a 720, you're probably gonna get approved for the loan. Even if you have a lower score, you might get approved for the loan. But what people don't understand sometimes is banks have these specific loan programs that are they base them off of risk-based pricing. What that means is if you have a lower credit score, you might be paying a higher interest rate compared to somebody else that has a higher credit score. at the end of the day, what that means is you're going to spend more money on that loan. You're going to be giving the bank more money on that loan than somebody that has a higher credit score. So a lot of people ask us, well, where do I start? And we usually will tell them, you need to start with a credit report, employer credit report, and get a baseline of where you are today, right? So there are 3 different credit reporting agencies. You can get them for free. I think I use Credit Karma myself, but there are a couple of other ones out there. What it's going to do is serve as your current inventory and where you are. And a lot of misconceptions around credit scores, which is interesting. And a lot of this doesn't affect your credit score, which is your job, your bank balances, your assets, you're checking your score. I believe you can check it weekly now instead of yearly for free because of COVID, but don't quote me on that, but I'm pretty sure you can. Bills such as utility bills, cell phone bills, those typically won't positively affect your credit score, but if they were to get charged off, they can affect it negatively. So when it comes to credit scores, what do we do? 2 main points here, if you're looking at the graph, is kind of seems like a no-brainer, but pay your bills on time. So pay them on time, make sure you're not skipping payments, make sure you're not going past the due date, right? The second thing is try to use less than 25% of your debt utilization. What that means is if you have a credit card for $1,000, try not to go above $250, even if you pay it off every single month, okay? Those 2 factors alone consist of 65% of your credit score. So if you can do well in both those categories, instantly you have a 65%, or I should say 65% of your credit score is going to be perfect. Then what you're going to want to do is let your credit history, your types of history, grow organically. Some things you're not going to want to do, obviously, is skipping payments or paying late. Those will negatively affect your credit score. Going back to the credit cards or your credit utilization, you try not to max them out. One example would be, if you, one of those folks that use credit cards for everything, you max out and pay it off every month, it's great. You're not paying interest to the bank. However, if you were to apply for a mortgage or for a car loan and they happen to pull your credit halfway through the month, they're going to see that you're at 100% utilization. So that's going to throw up a red flag potentially for the bank or the financial institution. Third thing, try to be mindful of applying for credit, except when necessary. A lot of people get tied up in promotional offers. You go to Macy's and you'll get 15% off on a purchase today, or you go and you can get 10% or 10 cents off a gallon at a gas station. Well, then those end up, building up those cards on your profile, creating a lot of exposure, which also can throw up some red flags for banks. So at the final thoughts, as this is a kind of a high level overview around budgeting and credit utilization, how credit scores work. The biggest thing is you want to be consistent with the simple rules. You want to have a healthy budget and a good credit score. And it's just proof that anybody can recover from life's hiccups. So I'd love to welcome any of you into my banking center. If you have any questions or you would want to take something offline, again, I'm at the 132 location permanently. We'd love to see your faces. And at this point, I'm going to turn it over to Darren.
I can take myself off mute here. Hello, everybody. So talking about mortgages and really the whole thing going to this kind of goes to Eric's point. It kind of dovetails on what he was saying. And it kind of goes back to financial preparedness and budgeting and really a game plan. So really what we do in our role, I'm a lending officer here on the residential side. And what we try to do is formulate what we call a roadmap to home ownership. And what that basically is a soup to nuts process we do to get those people, those first-time home buyers, to understand educationally the beginning part of the process and then work their way through the entire process. So really what it comes down to it is ultimately it's setting goals for yourself. And if you look at the charts here, it talks about what is your primary motivation. First thing you need to do is decide what you want to do, find out exactly which kind of property you want to get, condominium, single family, where you want to live, decide what it ultimately is. Are you going to stay in the same place for 3 to 5 years? And the reason why that's important again is just understanding some different programs. And what we do is we look at basically some different aspects to help get people qualified. Ideally, what we want to do is we want to make sure that folks have the ability to make their payments on time. We're in the lending industry. We're not interested in owning homes or anything like that. We want to make sure that we're creating this as a positive environment. So we do look at some different things, and what we do like to see is people having reserves in the bank. And cash is king as far as that, because when Eric was talking about credit, what's important to know about that too is when you look at these credit reports that we're getting, it doesn't show the whole story. We look at a credit report, it's going to show car loans, it's going to show credit cards, it's going to show student loans. It's not going to show food. It's not going to show childcare. It's not going to show healthcare. It's not going to show how often you go out to eat. And so, and also we look at your gross income and you live off of your net income. So right off the bat, it's an apples to oranges comparison. So we want to make sure that your total income is going to survive the debt. So a good way to handle that is to maybe put a little bit less down if you can and keep some money in the bank in case for rainy days. And that's certainly important. Credit history is to Eric's point again, is important because it tells the story. It is your ability to repay debt. It's your track record. As you get a mortgage, that'll certainly help you out as well. The other thing we look at is stability. Stability really ultimately is the whole name of the game anyway. We want to look at your stable job. We want to look at pretty much everything, because ultimately at the end of the day, when we do a mortgage with you, it's a partnership with you to help finance that home. So we want to make sure that you have a stable job. We want to make sure that you have a stable employment history. And, we do realize that it's not a perfect world. So certainly things are going to change and life goes on. And that's why there are several different programs. Any good first-time home buyer is going to walk into the bank and they're not going to ask what your rate is. They're not going to ask things like that. They're going to ask, what first-time home buyer programs do you have? And really it's up to us to help tailor that program with you based on your credit score, your income, your assets. And we kind of take all that information and work our way backwards into the ideal program for you. You only need one program. So what your neighbor has, what your friend has may not be the best program for you. It's important to find out what your individual needs are. And fortunately, your timing is good because there are a lot of good programs right now. And for the potential home buyer, it's really never been a better time, depending on the situation. But everyone's different. And to Eric's point earlier about the credit repairs itself in time. If you have credit issues, it's not the end of the world. Credit is like a broken bone. It heals in time. Depending on how bad you break it, I guess it takes how long it takes to fix it, but it will fix. And what we do in our role is act as financial counselors to help find ways to help increase that score as it goes on. Okay. And so again, going back to the whole roadmap thing, it really is important to really find out how much you can afford personally. Set a budget. And that's really the most important advice anybody can offer you is sit down and do it in pencil the first time, because you're going to lie and you're going to erase it. I'm telling you, find out how much you can afford. See where your money is going. How often you go out to eat, how often do you go to the beer store? How often do you go to the McDonald's and the Dunkin' Donuts? You'd be surprised how much Dunkin' Donuts adds up, by the way. Get one of those machines, those Keurig machines. They'll save you a lot of money. But see where your money's going. Everybody spends money differently. Some people like to donate money to their church. Some people like to spend money on different things. But when you put it to paper and you see where it's going, you can really help formulate a game plan because it's going to allow you to save. We mentioned the thing before about saving money for down payment. Put some money away, set up an account, and just forget it's even there. And the more you have, the more you put down, the more opportunities you're going to have with programs for us. The next thing you should do is contact your lender, hopefully Cape Cod 5, and ask about getting pre-qualified. Now, I would suggest you go and visit someone or call someone. I would suggest you stay off the computer. You get yourself into a lot of trouble on the computer, so it's definitely important to speak with somebody because you also want to set up that personal relationship with someone who's going to help look at what the best programs are for you. So you've done your budget, you've put some money away, you've gone to a lender, and you're getting pre-qualified. So now you know roughly how much you can spend. You've had your credit pulled, you know what the challenges might be, or there may be no challenges. You're ready to buy. So now you go out and you find a home. You go out and find a property. And I would suggest look at as many houses as you can because every house you see is the best house you ever saw. And the more you see, the better it's going to be. And don't be shy when you do find a property, if you get a home inspection, because that's the next thing you should do. That's your test drive. You're going to hire an independent home inspector. Believe it or not, most programs do not require it, but you should definitely get it. And find out what the deal is with the house. And don't take it personally if there are things wrong with the house. The person doesn't hate you or hate the house. He's looking to find out things. He's looking to find out things that might be wrong with that property. And one quick story, I know I got 12 minutes before they gong me here, but I'll tell you a quick story. We did a house one time and someone was buying a property, and the inspector didn't understand why the basement, all the walls were painted black. It was just black, and he couldn't figure out why. And after further inspection, it turned out that there was a fire down there, and the seller just painted over with black paint, and it had substantial frame damage on the property that most people never were seen. So that's why it's important to find out these details by a licensed professional. So once that's all done and you're comfortable,
hold on. Deanna,
yep.
Just have Deanna go to the next slide. Thank you.
Okay. That's all right. I memorize your thing, Jim. I know your game. Okay, don't worry about me. Anyway, so you've got the home inspection, and you are and you have the ability now to go ahead and feel comfortable moving forward with the process. This is when your pre-approval or your pre-qualification is going to turn into an actual loan. So simply, now we're going to be gathering more documents, your income, your assets. We're going to be doing a lot of documentation. Be prepared to hand us a lot of stuff because that's the way we work. There's a lot of documentation that we do need to verify everything. And again, it goes back to that stability question we talked about. We want to make sure it's a good investment for everybody. Once your mortgage is in place, you'll sign a legal document, the purchase and sale agreement. This is your contract. This is kind of the final step along the way to moving forward with this home. So at this point, you'll already have your home inspection done. You'll be confident that the bank is going to work with you. Your confidence is going to be everything is going to be in good shape. And any good loan officer, any good person at this point is confident that everything's going to work out fine. There really should be no surprises at this point. What happens, it goes back at this point to our underwriting staff. They will order your appraisal. They will do a lot of things like that. The appraisal is not to be confused with the home inspection. This is something we do that we're bound to do that is basically determining the value of that property. So again, it goes to that stability question. We've looked at your income, we've looked at your assets, we've looked at your credit, and now we're looking at the condition of the property and value of the property. So if you're paying $300,000 for a house, we need to make sure that it's going to be worth at least $300,000, just to make sure that we're not lending you more in the value of that property. I got a lot of people in trouble about 10 or so years ago. Basically, it's going to go through the underwriting staff, and they're going to sit there, and the more information we have, the better. It's going to move much, much quicker if you do it. The legal work will be done on the title, and that'll be all taken care of as far as getting that squared away. And then basically, once we get the appraisal back, all your documentation is back, we basically give the file to the attorney to prepare to set up your closing date. The closing date will be established by you and the seller on that purchase and sale agreement, and that's our target. That's what we work towards, that date. Assuming everything's okay, and usually at this point it is, it should be a pretty seamless closing process. Just make sure you bring your license to the closing, because that's been an issue for some reason. I don't know why, but that's been popping up. But again, it goes back to the very beginning, setting up that budget, making sure you know how you're spending your money, and then working with someone who is a professional who can consult you to help work through any bumps along the way. Because we've been doing this for a while and we've seen it all, although something new seems to come up all the time, but we can work through it as long as you're forward with us, you're honest with us, and we can understand exactly what the plight may be. But for the most part, if you're prepared for it and you're ready for it, the process goes very, very well, and you'll have a very seamless process. And that is the process.
All right.
So,
You all set there?
I don't think I know it was even on. I think I was, but sure. Yeah, I'm all set.
All right. Well, my name's Beth Grady. As Jim had said at the beginning, I am a wealth management officer at Cape Cod 5 with our trust and asset management department. And I get to talk about some really exciting things, insurance and estate planning. So with insurance, you really want to review your coverage annually. Homeowners insurance, you know, a lot of people will kind of every year just renew it and keep going along, but you really want to make sure if you've had any improvements done in your home, you want to make sure that you've notified your insurance company and you may need to increase your coverage. I've had clients who didn't realize they didn't have enough homeowners insurance, and we took a look at it, and if something were to happen, they would have had a large out-of-pocket expense. So you want to take a look at that. Auto insurance, obviously, we all have that. If you have a new driver in your home, you want to make sure that they're covered. Life insurance, that's a really big one. And there's so many products with life insurance that I can't really give, you know, a blanket statement on it. There's term life insurance, there's whole life insurance, there's variable life insurance, cash policies. I could go on for hours on that, but something to think about with life insurance is a lot of people within their family think they need to make sure that the higher wage earner is covered if something were to happen. However, you also want to make sure, you know, even if your partner is making less money, are they somebody that stays home more and watches the kids? You know, if something were to happen to them and you need to keep working, how are you going to afford daycare? Or do they help a little bit with the mortgage or the rent? So you want to make sure that everyone's covered there. Another thing that I have seen is, and I'm not telling you to run out and buy a policy like this, but sometimes when somebody is getting to retirement age, they are going to decide on their pension annuity payment. Are they going to get a single life monthly payment, or are they going to get, you know, a joint and survivor payment? Usually those joint and survivor payments are a lower monthly payment. And if you opt for the single life, which is often a higher payment, another way you can supplement any income if something were to happen to you for your partner is to get a life insurance policy. So now you've chosen the single life. Something were to happen to you, those funds can go to your spouse. Disability, that one is very much overlooked. We all think that we're going to be okay, knock on wood, but we've seen it with friends, neighbors, families. You want to make sure, you know, if your employer has disability insurance, you want to make sure that you are purchasing that. And sometimes you may need to look elsewhere to get a supplement plan as well. Health insurance, obviously, we all know how important that is. Taking a look at it every year, that's another one we're often on autopilot, just like homeowners and the auto insurance. Things do change. You may have different medications, so different health issues. You want to take a look at the year ahead and see if you need to make those changes. And then there's flexible spending accounts and health savings accounts. Flexible spending accounts are great in that you can put money aside. So every paycheck, pre-payroll taxes, you're putting a certain amount aside, and you can pull out money from your flexible savings account for qualified medical expenses. So you're not being taxed on it, which is a great thing. What to keep in mind with those is, you know, if you don't use all the funds that you've put aside in that account by the end of the year, you do lose the funds. A lot of times an employer will give you a sort of a grace period. So they may say, okay, you know, by March 15th, you need to use the rest of what's in there or you will lose the funds. So kind of every year, going back to what Eric said, when you take a look at your budget, think about, you know, what did my medical expenses look like this past year, so that you're not putting too much aside and that you can lose the funds. A health savings account, this is my absolute favorite product, and I think it's very much misunderstood. But what's so great about a health savings account is it's triple tax advantage. So you can put money aside pre-tax dollars. So, you know, you have no payroll taxes, you have no income taxes. And then if you take it out for qualified medical expenses, you're not taxed for that either. When you get a health savings account, it is with a high deductible plan, so that's something to keep in mind. A lot of people panic and they see high deductible, forget that, I'm not going to sign up for a health savings account. But what they don't realize is the monthly premiums are extremely low on health savings account plans. So you can take, the difference between what you would have paid at a regular health insurance plan versus the high deductible with the low premium and kind of put that aside in a health savings account. An employer often puts money aside in that as well. So again, triple tax advantage, you're putting aside, your employer's putting money aside, and you can take money out for qualified medical expenses, or if 10 years down the road you paid out of pocket for that expense, you can actually save that receipt and still take the money out and go on a vacation if you want, as long as you have that receipt that you did pay out of pocket for that medical expense. Usually those plans, once they reach about $1,000, you can also invest it. So if you're not planning on retiring for 10, 20, 30 years, it can be great as part of your retirement plan as well. And that's it on that slide. And then estate planning. What is an estate plan and what should it include? We've all heard that term before. There's sort of 4 key documents that you want to think about with an estate plan. So there's a power of attorney. There's different kinds of those. They can go into effect, if you are deemed incapacitated, or if you are closing on a home and you can't be there, you can set up a power of attorney for someone to act on your own behalf. Healthcare proxies, those again, a lot of people don't do those and they're super important. You can actually go to mass.gov and there's a free one right online that you can fill out, or even if you just wanted to see what one looks like. And once you have a healthcare proxy filled out, you're basically designating somebody to speak on your behalf if there's a medical emergency and you can't speak for yourself. You want to sprinkle those around to any doctors you have, specialists, hospitals, and then you want to make sure that obviously the person that you designated to help you knows where it is as well. Trusts, not everyone needs a trust, but the main thing to know about a trust document is that it can protect certain assets. It doesn't go through probate and it's private. You can list beneficiaries on that. And again, nobody can sort of look up like they could with a will and see who those beneficiaries are. That said, you should still create a will. What's most important, I think, in a will is as soon as you have minor children, that's really where you go to designate a guardian for your children. So I highly recommend, if nothing else, as soon as you have minor children in the home to create that will. And the slide can be changed on that. And once you create those documents, that's all done through an attorney. You want to review the documents about every 3 to 5 years unless you have some sort of major life event. So, whether you get married or divorced, have a child, if there's a beneficiaries, though, you want to review annually. And I don't even just mean with these estate planning documents. You want to go back and, take a look. Do you have a 403B? Who did you place beneficiary on that? I remember I was married forever before I switched it from my mom to my husband. So you want to think about those things. Maybe you have an IRA. I've seen clients that still have an ex-spouse listed. So definitely take a look at those. Storing documents, you can store documents digitally now, which is actually pretty awesome. There are some really safe websites. You can take pictures of the documents and upload it to the website and they store it for you. You can upload PDF documents, and then you can give whoever you trust a password. If you're naming somebody in those documents, you probably trust them enough to give them that password, so that if something does happen, say in the middle of the night, which emergencies most often do, they can pull that right up on the website. So you want to make sure you don't want to put those documents in a safe box. I see that all the time too, because you know, people can't get into it. So if you have your will in there, and you know, whether it's your personal representative, and they need to access that will, they can't get into that safe box. So if you don't want to store it digitally, you know, even a safe spot in your home and letting that person know where is a good idea. And then we have our closing thoughts. So it's better to look ahead and prepare than look back and regret. That is so true. Just to kind of summarize, really take a look at your budget. Don't get overwhelmed, just start simply. I know Darren mentioned even just jot it down on a piece of paper and see where you're spending. And then also get those estate planning documents done, or even at least talked about with those that you love, because when something does happen, it's very difficult to kind of go back and talk things through. And then again, if you're looking to buy a home, Darren gave some great insight on that and some tips. And that's about it, I think. I don't know if we're going to open up for questions or.
I would love to open up for questions. Thank you guys so much. Yeah. Questions, participants?
That the health savings plan, so that's different. That's different because you don't lose the money after the year. Is that correct? Is that what I understood?
That's a great point. Yeah, you don't lose it. So it can actually, not only do you save it, but you can invest it. So if you don't pull any money out, that's perfectly fine and is actually recommended of a great way of using it. It can continue to grow for the next 30 years. You can keep adding to it. You can invest it in the stock market. So you don't lose that money. It's yours and it's not taxed. So it's pretty remarkable. There's no other account like it out there.
So that would be appropriate for a young person, say in college, he's started his 401 Roth, but to add to that and diversify in that way, it seems like a pretty prudent move. Yes? Yes,
absolutely. Yep. And I think to your point, when, you know, if you're just starting out, most of us in that situation don't have as much medical issues as we start aging, and just sitting here, my back hurts. So using it in that way is really great when you're younger, because you can start to build. It also kind of gets, when you're just starting out in life, it gets you in a habit of just, you know, setting it up, auto pay. You don't even think about it as part of your paycheck. It's just deducted, it's set aside, and it's really like a retirement account. I mean, it's designed for medical expenses, but you can legally use it that way.
Is it accruing any interest?
Yes. So once it reaches, most plans are once it reaches about $1,000, you can actually go on and choose how you want to invest it. If you don't invest it, I believe it's just held in sort of a cash money market type account. But as soon as it reaches that $1,000, I would go online and you can choose your investments, you know, kind of knowing what your risk tolerance is. If you're, like you said, if you're young, you can do almost all stocks because you have, you know, a long time to go before you need it.
Thank you. Thanks so much.
Sure, you're welcome.
Thank you. This is terrific.
Can I ask, out of the members that are here on here, do any of you have our high deductible plans? Show of hands. No? Yeah, I didn't think so. We started offering them, oh gosh, I want to say it was 2 years ago now, and we're slowly having a migration of people going into them. So
I don't even know. How can I find out?
you have open enrollment. So one thing that we're very fortunate with the municipal health group is there's an open enrollment. Well, there's an open enrollment with all health plans, but with our Cape Cod Municipal Health Group, we have an open enrollment every year. What you would want to do, Marcia, is talk to your benefits office.
Okay.
You're in Barnstable?
Mm-hmm.
Yeah, you want to talk to Laura Scroggins.
Oh, perfect. Okay.
Okay. And you can change that once a year. And if it's not to your liking, you can change it to an HMO or a PPO the following year.
Okay, and I could talk to her about the health savings plan too?
Well, that's our HS, our high
that is
deductible
it.
plans
Oh,
are part of, yeah,
okay.
the, I'm gonna say FSAS. Never mind, I'm thinking of all the acronyms that are going through my head right now. Dealing with insurance, there's a lot of them rolling around in here. But yes,
Awesome.
okay. Elizabeth?
Yes.
Yeah.
As far as the health savings plan, once you can invest, is it in a particular product, or do you have freedom to go into any type of product you want? Or is it only something that, I don't know, Cape Cod 5 offers, or what are your options?
Yeah, so that's another great question. It's not actually something that Cape Cod 5 offers. It's done through your employer plan. So a health savings account, you would sign up for the high deductible health insurance plan, and by doing that, your employer or that insurance would offer you a health savings account. So every company or every town may use a different company for health savings account, just like, and I'm just gonna name drop random things here. Again, I'm not recommending, but just like, you know, you have Fidelity or Charles Schwab, all of that. A health savings account would use different companies like that, so it's up to who the employer chooses. You can also not choose the one that they recommend and go on your own and open one. There's, you know, you could Google them, HSAs, and there's companies all online. So for investment products, your question about, you know, can you choose within that company that your HSA is with, they will have certain options for how you can invest it and in what funds. I don't know if did that answer your question?
Yeah, thank you.
Okay.
Abigail?
Hi, thank you for this. This was helpful. So I have a question about home buying. So you talked about the appraisal and the home inspection and the lawyer for the closing process. How much money does that, or how much money should one expect to set aside to take care of all those other steps?
Well, it really depends on the program. I mean, there are some programs that offer 0% down. There are some programs that offer a little bit more. There are some programs that do offer that have higher costs for different reasons. I mean, there's really no rule of thumb per se. I mean, we always try to minimize it, make it as cheap as we possibly can. It's kind of a tough question. I mean, probably if you're putting 3% down, okay, you should basically, well, it's really tough to say, but you probably, with just closing costs, you have to prepay your first year of homeowner's insurance, and we have to hold back some taxes. That's probably going to be about $8,000 right there. So when you think about our down payment, what options you have, you know, if you're, and again, it depends on how much the loan is, but I would start right at that. And so there are some really good programs the bank has with basically closing cost type programs, especially through mass housing. You can get credit for those. There are also some really good housing agencies that can help you with closing cost down payment assistance here on Cape too. But just for actual money, I would probably start at that. And it's going to go up depending on the type of program you have. So that's probably the minimum when you really think about it. So when you start putting money away and saving it, we talk about reserves and things like that. And that's really a luxury to have. But it's expensive, and that's really what you want. You want to put some money away the best you can. But keep an eye out for the options to get that, though, because there are some really good programs out there to help with closing cost assistance that any of us can help you with that and direct you those directions too.
Thank you.
Okay, sure.
Anyone else? Michelle?
Hi, so I have never budgeted, and I think that I'm interested in knowing if there are any tips on a way that it can like be less time consuming. I have 2 young children and work a lot of hours, and I just can't imagine an easy way to track all of my spending and everything for a month. So yes, I don't know if anyone has any products that they've used or anything to help with that.
I mean, I've a pretty good grasp of where my money's going every single. I have a 2-year-old now too, so I understand where that money's going as well. But I mean, just do the best you can. I mean, doing something is better than doing nothing. You know, maybe a good spot to start with is take out a bank statement. You know, take out the bank statement for September and see, you know, do a chart list. This is what my income is after taxes. This is what, you know, my bills are. I mean, you should have a pretty good understanding of, you know, if you're renting, what your rent is, or your mortgage payment, what that is. Your car payments should be pretty familiar with that. So once you take out the core that you need to survive every month, right? So it's utilities, mortgage, car payment. You can throw in there, you know, what you think your estimated maybe grocery bill is. You know, then subtract that from your income. That's gonna give you the amount that you have to play with, if that makes sense. I boil it down really basically. I say, here's my income, subtract my mortgage payment, my car payment. I divide everything by 2 because I get paid twice a month. I say, this is how much money I have left over. And I've come up with an idea of how much I want to take out of that and save it into my savings account. So then the rest of it's kind of my play money, or, you know, the slush fund, if that makes sense. Again, the technique's going to depend on you, how you want to run it, how involved you are into it. Again, you can just do a very basic formula. What you know your debts are, or what you're paying out every single month, subtract that from your income, and that's what you have left over. I don't know if that answers your question or not, but we do have tools at CapeCod5.com. There's a ton of them that we just launched for helping with budgeting, helping with credit scores, helping with, you know, what your mortgage payment would be. So there are, you know, different types of calculators and things like that out there, and especially Cape Cod 5, other banks will most likely have them too as well, to help you with that. So, or if you go with spreadsheets, create a spreadsheet. It really depends on your ability, really. But as long as you're doing something, at least you're ahead of the game, if that makes sense.
Could I make a suggestion too on that? Because I recently went through that. Sometimes on your bank statements, like if you have electronic banking, you can sort by who your payee is. So if you want to, and you can sort through a particular amount of time. So you can get totals for the year fairly easily, which is really helpful. I know I just had to go through a whole bunch of that. So. Sorry.
That's a good example. Your bank statement should also show you what your income was for the month and what your expenses were, you know, what the money came out. So it'll give you a good base point.
Yeah, and as someone that ran through with spreadsheets for years, which my wife thinks is ridiculous, we started using mint.com, and it's not a plug for them, but it has been a really good tool, because they track everything. You can link accounts. Yeah. And it's similar to a lot of the accounts that, you know, or a lot of the tools that Cape Cod 5 is starting to develop. But mint.com has been a good one. You get a lot of ads for random things like mortgages, etc. But it tracks your expenses, and you can allocate things as far as what's going towards vehicle maintenance or home maintenance or mortgage or groceries, etc.
Great. Thank you.
Thank you, everyone.
Michelle, I also wanted to just tell you quickly that if you're just looking for something very basic and very entry, Google has a sheet that you can use that's already with predetermined fields, and Excel has one too.
Okay.
Just in a document you can go in if you're just looking for something basic too.
Okay. Great. Thank you, everyone.
Sure. Renee?
Hi, everyone. I just have sort of a quick question. I hear this a lot, and I've heard it over the years. So I'm in the process of refinancing, and I've been pretty self-disciplined with how I've handled my mortgage for quite a while. I have probably about 8 or 10 more years left, but I want to refinance. I want to get the nice rate they have right now. I always hear a loan officer say, there's no prepayment penalty. So just to get some comfort, of course, it's COVID, but you know, maybe you could do a 30-year loan, and you've been so disciplined. We see that you would be someone that could handle that. Or you could do a 15. I mean, to me, it's fine because I know that I'm probably going to pay it the way I'm paying it now, whether my payment is lower or higher. It's going to be 8 years anyway, but you know, what is the disadvantage of saying it's 30 more years? Is there a disadvantage?
I guess I'll take this one. There's no disadvantage. The 30 years it just means that's how long the payments will spread over. It doesn't mean you gotta consistently pay that. Anything you pay above that minimum payment is going to go to principal. The other thing you can look at too is also 20-year loans too, somewhere in the middle. Ideally, when you refinance, you start with the 30, you refinance, maybe you go down to a 20 next time. You kind of work your way down. Most 30-year loans less than 5% of loans in this country make it 30 years because people refinance, people sell. It's just the statistics. So it really depends, again, like we said at the beginning, assuming you're going to stay in that property, it's coming up with a game plan to get that mortgage paid off. There are some people who have no intention of paying off their mortgage. They just want to keep their payments low, and maybe they'll sell it, maybe they won't. But there's really no disadvantage. Certainly if you're refinancing to a 30-year, it usually means because of rate, or you're going to be taking extra cash to pay down some debt or do some sort of home improvement. So everyone's a little bit different. I would always remember it's a very individual thing. There's no rule of thumb per se because everyone's goals are a little bit different. If you're saving $200 a month on your monthly payment, that's an eye of the beholder thing. That's maybe a lot of money to some people, may not be to other people. So it really depends on what your goal is. But there's no downside whatsoever in going back to a 30. You'll lose a little time, but if I just make an extra manageable payments with no prepayment penalty, you can catch up on that time very quickly.
So my thoughts were a 15 with intentions of, paying it off still in the same 8 to 10 years is probably what I would do. And so I just wanted to ask that question because the old timers in my life say, don't do that. And I couldn't see any reason why not to. So I was trying to figure out, are my old timer friends right? Or, have things changed or, so thank you. I know that might've been a silly question, but I really wanted.
Not a silly question. Oh, it's a good question. It ultimately depends on what your people around you say. It doesn't really matter. It's what you think of what your goals are. And that all goes back to that long-term budget. You should always have a short-term budget and always have a long-term budget. And long-term usually involves paying off your house and then finding out the best way to do it, whether it be refinancing to a shorter term or keeping the long-term and keeping that lower payments and throwing extra money towards it. The key is, to your point, is the no prepayment penalty. That's the one you really want.
All right. Thank you.
Sure.
Anyone else? Any other questions? No?
Yeah, I have a quick question. I'm not sure I joined a little late. But I've been going through thinking about retirement planning and how the system's set up with the county. And I wasn't sure because the county has a standard retirement contribution requirement, and then there's a 2% adder. Is it better to keep that with the county retirement program or invest that into a 457B?
Matt, if you're,
I'm not sure if any of the folks from Cape Cod 5 are well versed in that, but I was just going through and figuring out because the return on, go ahead.
I'm sorry, if I understood you correctly, you were asking if you can put your money into a 457 or some other avenue. And if you're actively employed right now, you don't have a choice with that contribution to the state board or county board of retirement.
With the additional 2%?
I believe so. I believe that that's state law. It's based on hiring dates. The percentage that you pay is based on the hiring date.
Okay, because they show up as two different lines, so I wasn't sure if that was required. When I got hired, it was an optional additional, so I wasn't sure which the better avenue would be.
Okay, I can double check on that though and let you know.
Yeah, and I can check with Maggie too. Maggie knows pretty well. I can tell that you're.
Maggie just left. I would have asked her.
I was going to say,
sorry.
I can tell from the background that you're sitting where across
I'm in your
the table
office, I
from
know.
where I was sitting the other day. So
Right. No,
Yeah.
I'm about 95% positive that you don't have a choice in paying that because of state laws.
okay, yeah,
Yeah.
I just wasn't sure.
Okay,
You know,
but double
it's got
check
a
with
long
her.
time to retirement, but
Right, right.
we'll see.
Okay. Anyone else? All right. Well, thank you all so much for joining us. I hope you found it worthwhile for those of you that didn't have questions to ask. I saw a lot of nodding, so I'm hoping that was great. Thank you, Jim and Darren and Eric and Beth and Kareem. Thank you all for being with us. I hope we can do this again. And I'm sorry, we only had, we didn't have quite as many as had signed up to be here, but I think that this went fantastic and I think the content was awesome. I learned a couple things in here too, so that was great. I always love to be able to take a little tidbit home with me too.
Perfect.
Awesome.
We
And
had a
thanks
blast.
for-
Thank you.
Yeah.
Yeah,
and
thanks.
So
for-
grateful to be asked.
I know, and so thanks so much for working through dinner and family time. So I know our lives are all so hectic right now and everybody's schedules are all over the place. So I appreciate it even more. Thank you so much.
Thank you, guys.
My pleasure.
Let me know if you
Absolutely.
get any other follow-up, Deanna, okay? If you get
I-
something later
I
that you
am.
need me to answer.
I'm going to try and send out just a quick survey monkey to people and just ask. And I'm sure, or I'm not sure, but I'm pretty sure that Jim probably shared with you that in our conversations that I'm hoping that maybe we can get you in to do some more of these, maybe someday in person if we're ever allowed to do that ever again. With estate planning, retirements, maybe have our I can have someone from our retirement board come in and we could talk about additional things. And there's a lot of people that need a lot of help, and I know in particular with our public employees, and I can speak from firsthand knowledge because I was a benefits administrator in one of the towns before I started my own business. A lot of employees come in and they stay forever. So they come in at 20 years old or 30 years old and they stay until retirement, and they don't change any of their benefits from the date that they start. They don't, maybe they might join a 457, maybe they might, but they're never thinking about retirement until it's like a year before they're supposed to retire. And then they all get that deer in the headlights kind of, oh my God, I don't have enough, or I don't know what I'm doing. So that's something that I would really like to have people, around 50 start thinking about. Hopefully earlier, but I can't seem to reel them in before that. So anyways, with that, thank you so much again. And I look forward to seeing you again, I hope.
You will. Let's keep in touch, and thank you again for having us.
Okay.
It was great. It was an honor.
Excellent. Thanks everyone so much. Have a good night.
Bye-bye.
Hey, everybody.
Bye, dinner.
See you guys. Go eat, Pardo.